Thanks. Good morning, everybody. I'll just do a quick run through. Firstly, thanks for joining us, and just do a quick run through of the slide deck that you should see in front of you. Again, for those that don't know the company that well, we have 3 jurisdictions: Melbourne, which is our main office; Berlin, which is our R&D for the Visage product; and our US headquarters in San Diego. We pride ourselves on the majority of our staff being technical and have over 40 software engineers. We have 2 product sets, the Visage RIS, which was our original product set, largely Australian-based, and again this year it performed well, and Visage 7, which we sell mainly in the US but also in Europe and also Australia. In terms of our financials this year, we felt that all of our numbers headed in the right direction. Revenue, taking into account the new revenue recognition standards that came in this financial year, was up 50.1 million, up 47.9%. Again, profit after tax, underlying NPAT, and our EBIT margins all went up. Our aim with margins at the half was to reach 50% or more, and we think we achieved that, so we were pleased with that. Cash reserves went up 28% to 3.23 million, and we announced the fully franked final dividend of 4.5 cents, which was so the total dividend went up by a total of 75% year on year. In terms of the year in review, it's 12 months is a long time, but we think we've achieved a lot. We announced CARL, which is a growing regional group in the Midwest. Our biggest announcement was partners in November. The December announcement of the $3 million German government contract, VA Veterans Affairs extension, and in April of this year, another Tier 1 academic in Duke Health. And we are pleased to report that we are on and ahead of schedule in terms of our implementations, and we'll talk about the pipeline towards the end of the presentation. The message for this year, which we felt worked well, was the operational model. As you know, most of you are familiar, it's used in the vast majority of our US contracts. We now use it for our risk contracts in Australia, in particular the Helios contract. And going forward, our contracted revenue for the next 5 years increased to a minimum of 180 million, and we still see upside as client examinations grow. So we think we've developed a strong annuity stream with far greater predictability than the previous capital sales model. In terms of the exam revenue, I think the key figure was 43.5% increase year on year. We think this will continue because FY19 didn't have any revenue from partners or Duke, which will all come in 20. But we did get growth from existing and new clients, and clearly started to see some of the impact of Visage 7 Open Archive, which we were pleased made a material contribution. Professional services, again, this is one area that has changed the most this year with the AASB 15 revenue recognition standards. What we see is this will now be spread over the life of the contract rather than being brought to revenue as the milestones are achieved. Clearly that will have some impact, not in the total amount of revenue, but its distribution over the years going forward. The FY19 revenue split, I think, shows we think very strong progress in this year. The salmon-coloured bar at the bottom being the transaction revenue, as we said, grew over 43%, and the light green at the top, the professional services, is representative of the new standard that we restated from the previous year, so you could see like for like. The only thing that in this year that was more of a one-off was the capital sale of 3 million, which was in the first half, but we think we built solidly in the second half, built on top of the first. In terms of operating leverage, most of you are aware we believe we're very highly scalable. There is no CapEx. It's a software-only model. We have a relatively fixed cost base, and our margins continue to grow as our footprint increases. Clearly, the next slide shows that. We're at about 48.5%, just shy of 50 in FY18, and we're able to break through the 50% barrier to 51.6 in this financial year. Some updates on the clients we announced. Partners, as most of you know, it's the largest health system in the state of Massachusetts. It is the largest employer with 75,000 staff. Two things in regards to that. Mass General moved up in the ranks of the best hospital from number 4 to number 2 behind Mayo, and Brigham and Women moved from 20 to 13. They are two teaching hospitals for the Harvard Medical School, and both hospitals, or both groups, are renowned for their data science and clinical sciences labs, which is important for us going forward in terms of collaborative research and commercialisation. In terms of the deal, we can now report that it is now, the project is 95% complete. We signed the contract in November, went live at our first sites in early July, and all except for one division at Mass General, we're waiting on a third party. Phase 1 is now complete, so we're very pleased with that. We think we've done that in record time, and we will complete the last component, the last 5%, now slated for September, October. So before calendar year end, we believe we will have completed all of phase 1 of Partners. In terms of Duke, just reiterating, it's a 7-year deal, minimum value of $14 million. Duke are a Tier 1 academic, as are the hospitals in Partners, so that spreads our footprint across the Tier 1 academic space in the US. It is scheduled to go live in early third quarter financial of FY20, and so we believe that it will contribute to the last half of FY20 and clearly be a material contributor going into FY21 and onwards. In terms of the implementations, as I mentioned, Partners was the big one ahead of us. I think we've completed it in under a tenth of time, is my estimate of a competitor, or even quicker. We have the last bit to go, and that clears the deck, and as I said, Duke is still ahead of us. But all of our other implementations have all been completed, so we're really ready if we are successful in gaining new business, which we plan to be, to implement those as soon as those clients are ready. The other thing we are seeing, and it is helping us in the market clearly, is the proven ROI. We are seeing in every single instance, Partners included, significant IT and infrastructure savings. We are seeing increased radiology efficiency even in these earlier stages, and feedback from the clinical units is that they believe that they are getting greater ability for greater clinical accuracy simply because of the amount of data we show them and the fine-grained nature of the data that we show them. So all in all, we think our claim to offer a superior value proposition has been validated throughout our client base and now with Partners going live. The pipeline, we often get asked about that. For those that saw my commentary in the open briefing this morning, clearly in the last 6 months, both Partners and Duke transitioned from pipeline to contract, but we have been very active on the RFP front, both end of calendar year 18 and early first half of 19, and we've been able to backfill the pipeline with some new opportunities, and clearly those that have been in the pipeline before Partners and Duke are still progressing. So we're very pleased both with the quantity and quality of the opportunities, and as you'd expect, some are in a more mature phase of the cycle, some have just entered the pipeline, so it is, we think, a healthy and robust pipeline going forward. Just to finish off on the last two slides, we talk a bit about artificial intelligence. I know there's a lot of talk about it in press, not just in the medical circles, but in all circles. Certainly we think that healthcare imaging is ideally suited because radiologists, the key part of what they do is trying to match pixels and work out what should or should not be there. And clearly machine learning is well suited to that. We think we're well positioned to take advantage of this emerging technology simply because our programmers, our core strength, our intellectual strength out of Berlin is in this area. They are all PhDs in image processing in health, which is what AI is. We think our architecture is very well suited. We are based on GPU technology, which is used in AI, so our existing clients won't need any hardware or additional things to run algorithms and teach their systems. And finally, we are, with Duke and with partners, extending our footprint in the academic research space, and we now have 5 of the top 20 hospitals in the US as Visage clients, which is more than any of our competitors. So we think that will have a flow-on effect in our ability to do collaborative work with these Tier 1 clients. So how are we going to use it? I think we've already started putting AI into our product set under the hood, automating and making things more automatic as we go. We also see a great strength in having the same platform used for research, initial validation, preclinical validation, and put out to the clinicians without any change of the platform is a massive thing for these larger institutions. And we are in discussions with a number of institutions and third parties about putting algorithms or validating them on our platform so that it is integrated for the radiologist rather than being separate applications as most of our competition would have to do. So we feel that it is the platform will now extend into these areas, and it may be possible that we do joint collaboration with our clients to actually release some of our own algorithms as well. So the platform will support algorithms from clients, other third parties such as startups, and possibly some of our own in future. So just in summary, we are very pleased with the period. We are strongly growing our North American footprint, and we're starting to see the network effect in that. Transaction revenue went up over 43% year on year. We still believe we have leading technologies, and my commentary in the open briefing was the 18 to 24 months we think is still a valid assessment of how far we are ahead of competition. I think proven implementation is resonating with the market because this has been a sticking point for a number of competitors in the past that they've had difficulty implementing, and the fact that we now have some of the largest, most sophisticated clients that have been implemented in very short order, I think is equally as important as the technology itself. We are seeing more and more about the value proposition. We are seeing more interest in Visage Open Archive, and as I mentioned before, we think we're strategically positioned to leverage AI as it becomes mainstream going forward. So thank you very much, and now maybe we can open it up for Q&A.
Thank you very much. If you wish to ask a question via the teleconference, please press star then 1 on your telephone and wait for your name to be announced. If you do wish to cancel that request, you can do so by pressing star and then 2. If you are on a speakerphone, please pick up your handset before you ask your question. Also, if you do wish to ask a question via our webcast, please enter it into the Ask a Question box and click Submit. Your first question comes from Gary Sheriff from the Royal Bank of Canada. Please go ahead.
Yeah, hi Sam. A few questions. Firstly, I just wanted to get a sense in relation to any existing contracts coming up for renewal in the next 12 months, and if so, have you begun talks with them about renewals and potential price changes?
We have one. It's 12 months away. The first one that came up was Veterans Affairs, which we announced was renewed for another 5 years. That was in the first half. The next one won't be in this financial year. It will be early in the following financial year, and we've started preliminary talks.
Okay, thank you. Our next question, just in relation to, I get the sense that implementation is, you've really only got 2 more contracts for implementation, and I'm just wondering, in terms of opening the funnel a bit to scale faster, could you maybe give us some sense about whether or not you could add additional hunters or business leads to perhaps grow that pipeline?
Look, we're always looking, and we have mentioned that we are, incrementally adding people. We've incrementally added some staff to our, training and clinical apps base in the US over the year, which is what we plan to do. We are looking at possibly getting some additional salespeople, but we don't think at this point that we're missing out on any major opportunity because of lack of bandwidth. And bear in mind that when we announce some of these implementations like a Partners or Duke, they're the big ones, but there are always things going on in background. But the important thing for me, certainly as CEO, is to make sure we have capacity to implement new clients as and when we get them. And I think we're comfortable with that. But, we are incrementally adding to our, base, particularly in the US, and again, also to some of to our R&D base back in Berlin, pretty much as we've told the market we would be.
Thank you. And another thing, I know this was a little while ago, but I certainly know when the US political environment was, I guess, a little erratic with Trump coming into power and potential changes to Obamacare, there was a clear deferral of buying intent across the US healthcare system. And I'm just wondering, politically in the US, things are getting more erratic on a global stage. I'm wondering, is any of that filtering down to healthcare? Are you seeing any change in buying intent from hospital groups or any deferrals of planned RFPs since we last spoke?
No, the opposite. Look, health is a little different. Every industry has its nuances, but we don't. We're a little bit more shielded from some of the macroeconomic things that occur, like trade wars, interest rates, consumer sentiment. Now, you're not 100% shielded, but you are shielded to a fair degree. And I think the clients that we are dealing with, particularly at that, tier 1 end of the market, we don't see anyone taking their foot off the pedal. Quite the opposite. Now that they've rolled out their, electronic health record and looking at imaging, we're seeing, if anything, increased activity.
Thank you. Your next question comes from Chris Cooper at Goldman Sachs. Please go ahead.
Hi, morning, thanks. Just firstly on partners, so phase 1 is substantially complete. Are you now in a better position to help quantify the timing and potentially the size of that revenue opportunity in the second phase of that project, please?
With partners?
Yeah.
I think it's a little early because a lot of people in North America are on holidays and, we need the dust to settle. So I think it's a little early for that. But the fact that we've been able to get, the vast majority of it done, I think puts us in a very strong position because, leadership will look at it and go, okay, it's working, it's in, what do we do next? But, these are big organisations. So, look, we don't have any firm indication other than feedback from leadership as being, extremely positive, not only in the speed of implementation, but the uptake from the clinicians. I think when phase 1 is done, we will have trained 600 radiologists. So it's a massive implementation across multiple campuses. And the only reason we haven't finished that is we're waiting on a third party who needs to complete something to finish one division of MGH, one of the smaller divisions, before we say we're 100%. But so in answer to that, we think, look, we're in a good position, but it's a bit early for that call.
Okay, maybe you can just give us some sort of indication then, just phase 2 relative to phase 1 in terms of the overall opportunity, just to help us sort of contextualize how big that potential next stage could be for you.
They've told us it's about 25 to 30%, because phase 2 is a whole lot of other hospitals. They're not as uniform in terms of, how they work as, let's say, Brigham Women's, which is a number of hospitals, but they're all under Brigham. So we've been told 25 to 30% of phase 1.
Thank you. And next question on the pipeline. I mean, I hear your comments on the RFPs. Could you just comment, please, on the absolute number? I mean, you had a strong finish to calendar 18, a good start to 19. Could you just comment whether the absolute number of RFPs is higher or lower than it was 6 months ago? And also just on how they progressed. Of those that you had 6 months ago, what percentage have advanced and what percentage have not progressed?
Okay. I think the number is, I'm sure the number is high. We don't put out a number. We're under non-disclosure with clients. It's more than 10. That's all we can say. And the key ones that we had been working on behind Duke and partners that clearly were in the pipeline by November last year, those opportunities are still progressing. So this is, people go away for holiday. This is the time that a lot of things move forward when they come back in August, running up to RSNA and the end of the year. So we're pretty happy with how that's all going at this point.
Thank you. Your next question comes from Josh Kannourakis from UBS. Please go ahead.
Hi, Sam. First question from me, just around the RFPs. I'm interested in the nature of the conversations you're having with those parties and whether or not those conversations are expanding now to more broader enterprise imaging and potentially conversations across some of the other department offerings and other ologies.
Yeah, look, I think when we have, and this has been consistent for a while now, when people look at us, sure, they want to know about radiology, but they also want to know about inherent capability for other ologies as they go forward. So that's a standard conversation with these bigger groups. I think we're also making the transition more now into, what about AI research type? Where is our mind at? And, we tell the market that clearly they want to understand what our capabilities are going forward. So it's really in those two main areas outside the key product set. And the only other thing I will say is we are getting some of the new RFPs where they're interested in the archive from the get-go. So, if they do go ahead, it would most likely be viewer and archive. So, those are three dynamics that we see in conversations we're having.
Great. And just on the cardiology side of things, and obviously there's other ologies that some of the players are addressing, like pathology out there at the moment as well. I mean, how progressed are you in terms of getting it technically right to have a go-to-market product that you think will be market leading, or at least be able to compete at least at the level that the existing guys are at? Okay,
pathology is a whole different animal.
Yep.
So I leave that one aside. There are very few products that do pathology in it. And when we talk about pathology, bear in mind most pathology is biochemistry. It's blood tests and serum tests, and there's no imaging in those except blood films. But the majority of pathology doesn't require an image. It's mainly histopathology, which is tissue, and things like some blood slides. But that aside, look, we think we have a good offering for some of the other ologies already. It may not be 100% of everything, but certainly more than enough. And there's an attraction in using the same application, same technology, same servers as they do for radiology. So. Look, I think the thing that's holding us up the most is, people getting their head around breaking down different departments and having one imaging vendor across multiple departments. But we believe that will happen. It just takes time.
Thank you. Your next question comes from Sarah Mann at Moelis Australia. Please go ahead.
Hey guys, just on the US, so obviously you delivered a pretty strong result there. Just wondering if you could help me understand how much of that, 43.5% uplift in transactional revenue kind of came from existing contracts that, did better than expected volumes versus, new contracts like Yale and Mayo ramping up in the period versus any benefits you might have gotten from, I guess, the weaker AD leading to translational benefits at all?
Hi Sarah, it's Clayton here. I think it's a mixture of all. I think the majority was from existing customers. So the majority of it went up because of existing customers coming on board. But as you know, with some of those customers coming through the period like a Yale or a Mayo having a 12-month period of transactions, that obviously boosted it up. The pleasing thing was there was one quarter, April through to June, of the Mercy Archive transactions. So clearly in the FY20 year, that will increase for a full 12 months. And as Sam mentioned previously, both the partners that's gone live will have revenue for the FY20 and Duke will be in the second half. So there was some from prior years where we got additional revenue from existing, small amount on translation on the US, but a majority of it was increase of existing customers.
Great. Okay. So then the other question I just have is around partners. So obviously it's 95% there. A number of the sites have gone live. Can you maybe talk to, I guess, how the go live experience has been there compared to, say, I don't know, Mayo, Rochester, which I know was kind of the biggest one today?
Yeah, look, with each one that we do, clearly we get more and more adept at doing them. Partners was different. It was very different because normally what we do is we do campus by campus or region by region, but because partners had Brigham Women's and Mass General that in the past worked totally independently of each other, this is the first time in over 20 years they're on the same platform. Their go live was different. So we did body imaging at both or, neuroradiology at both. So we did it by division rather than by campus because they didn't want to show a favourite who should go first and who shouldn't. So that was a little unusual for us, but it worked very well. There were 3 waves, as we call them, a few weeks apart, and different, specialities went live in each wave. The only reason, as I mentioned, we didn't get 100% complete was because one of the worklist vendors needed to interface to a specific third-party package in that particular department, and they weren't ready, so we got to 95%, but the last few percent will be done, and that particular division, that particular subspecialty, didn't go live at MGH, but it did go live at Brigham. So it wasn't because of capability, it was because of that. So that made it a little different. And also the speed at which it was done. We started in July and finished about 2 weeks ago or a bit more. And they're the full 3 waves. And I don't think anybody's been able to do that in that sort of time frame.
Thank you. Your next question comes from Claude Walker at Ethical Equities. Please go ahead.
Hi guys. Thanks very much. Look, just thought I'd start with the traditional question. In the past, we've talked about how many tenders we've gone for but not been successful for whatever reason that may be. I think I still had that as 3 in total ever. Is that correct? We're talking about Visage here.
Yes.
So that's still the same?
4. It's 4.
4 now?
Yeah.
Okay, 4.
Yeah.
I might have been... And does that 4 include the one that we initially lost and then they came back wanting it after all?
No.
No, okay, cool. Thanks for that. And the other one was, you may not have a view on this, but we obviously have very strong free cash flow this year relative to profit for such a fast-growing company. Do you have any idea of where free cash flow might sit relative to net profit after tax over the next few years? Like, what's sort of going to be the average conversion there, do you think?
Yeah, Claude, it's Clayton again. I think with the new accounting standards, the free cash flow should increase over net profit because, as you know, the professional services we will still invoice and receive payment for over and above the revenue recognition of some of that. Also, if there is a capital sale in the future, that will occur as well. So we can't comment on exactly what it'll be, but I assume it'll be higher than the net profit of the business because of the new revenue standard, where we'll receive cash in advance of actually recognising that revenue in the accounts.
Thank you, Clayton. The last one, I think you already clarified this, but I was just going to check with the US hiring, was that in implementation or in sale?
Implementation.
Okay, that's what I thought. Cool. Thank you very much.
Thank you. Our next question comes from Peter Michael Burke from Select Equities. Please go ahead. Pardon me, Peter, your line is now live. It may be muted. Please go ahead.
Can't hear you, Pete.
We will move on. Our next question comes from Stella Wang, who is a private investor. Please go ahead, Stella.
Hi, good morning, guys. Really good results. Thank you very much. I've got two questions. The first one is digging a bit deeper and broader on the pipeline. Now, it's encouraging to know the customers are interested in archiving from ongoing in RFP now. Could you help us understand, originally you have the strong product of imaging. If we say that's $100 coming to market every year, now with archiving, how much bigger is the potential pipeline? And then later on with people ready for enterprise imaging, how much, again, is that quantum of pipeline going through every year?
Yeah, well, on the archive side, you don't charge as much. I think we've always said there are three components to a solution: a work list, the viewing or diagnostic layer, which is what our key product is, and then the archive that stores or manages the storage of the images. But, you know, for us, archive is material. You don't charge as much, but for every image that's viewed, it has to be stored. So yes, I mean, our first sale was to Mercy, which we announced. We were lucky because it's one of the biggest archives in the country. I think that in the end there were over 28 million images in there, and radiology images are large, so it was a significant job. And look, archive is not for everybody. People like Partners have their own archive at the moment that they had from another vendor, and they're happy to continue using that. Again, we may see in 3 or 4 years when that comes up for renewal that we think we'll get a look at it, and we are speaking to some existing clients on that basis. And again, as I said, not every RFP, but some of them, some large ones, are interested in having both viewer and archive because they're looking to replace a legacy system with a more modern one like ours. So, look, archive will never be as big as viewer, but you know, it could be somewhere between 30 and 40%, you know, across our market. Enterprise imaging, that's a lot harder to quantify, simply because it's such early days. Again, I would look at it at somewhere between, off the top of my head, 25 to 50%. But you know, it could become bigger than that if it's used in a ubiquitous manner. But you know, that will take a number of years to ramp through. So you know, hopefully that's answered your question.
Yes, very much. Thanks for that. The second question is simple and direct. You guys used to have the plan of increasing the liquidity of the stock by reducing some of your own holdings, you and Anthony. We haven't seen much of that. Is that still the plan?
Look, we announced to the market a year ago that we would possibly sell up to 3 million as shares, and as you know, we've sold 1/3 of that. I don't think there's a fixed plan, so you know, we just take it as you know, depending on circumstance, So there's no fixed plan or no fixed commitment at this point.
Great. Thank you very much. I'll see you guys in AGM.
Thank you.
Thanks.
Thank you. Excuse me. We will now take some questions from the webcast. Your first comes from Alexander Diab at IFM Investors, who asks, how much of the upside came from organic growth, volume versus FX?
Yeah, I think we spoke about this with some of our transactional revenue. The majority of it came from organic growth from some of our existing customers. We can see the exam volumes increasing, period on period. We do see it quarterly, and we do see it going up from customers or as they roll out new sites. So I think the majority of that was, the majority is through organic growth. Yes, we did have some upside to the Australian dollar weakening against the US, but again, that flows through on our expenses side in the R&D development, which is in Berlin. The majority of our expense comes from there, and that's reported in AUD. So on the flip side, we have that. It sort of weighs each other out a little bit. But no, the majority was from organic growth.
Thank you. The next webcast question comes from Nick Robertson at Yarden, who asks, how is the competitive landscape evolving? At least one competitor has outlined an aggressive market share growth target in North America. Is the landscape becoming more competitive?
That's a good question. The answer is that North American market's always incredibly competitive, simply because it's the biggest market in the world and everybody wants to be there. We have seen some change. We've seen a competitor list IPO a while back. We've seen Philips, which is a equipment manufacturer, but has also been active in the RT side of radiology, acquire Carestream, which was again one of our competitors. But no, I think, look, for every one that comes, there's another one that seems to fall back a bit. So look, there's always a lot of competition. We are a premium product with a premium price. As expected, some of our competition are pulling the price lever and dropping their price. But thankfully at this point, we've been able to fend all that off and, been able to win far, far more than we've lost. As we answered before, there have been 4 key ones where we haven't won, but all have gone to different competitors. But clearly we've won, 13 since then, and we hope to continue.
Thank you. Your next question via webcast comes from Charles Cantrell from Yarden, who asks, with only 4 lost tender processes, could you comment on Vanderbilt and New South Wales Health tenders? Both of these seem to be won by Sectra. Did Pro Medicus not make a tender for these? And if there was no tender made, would you mind explaining why?
Yeah. The answer is no, we didn't tender 5 of them. Vanderbilt, they had not engaged with us at all. I think they're relatively small. So not everybody will come to us. It's possible that they already had Sectra in some capacity. We don't actually know. But no, we weren't in any competitive situation or open RFP for that one. With New South Wales Health, we tend not to deal with government simply because it's so difficult. And so we were not part of the RFP process on that one either. But where we have competed with Sectra head-on-head, some of the main ones like Mayo, Duke, those ones we've won. Clearly, just on that, whilst we have a big spread and we're well known, we won't get to see every single opportunity. It's not possible. And particularly Vanderbilt, which was a smaller one, no, they did not approach us.
Thank you. Your next webcast question comes from Ian Lee at Allianz Global Investors, who asks, can you please address Australian contracts and the potential to move to a SaaS model? Thank you.
Okay. Well, the Australian contracts at the moment are largely on the risk practice management side. Both of those are progressing well. We are rolling out multiple practices a week for Healius, previously known as Primary. That is progressing well and on track. And with IMED, we are rolling out new sites. They announced a new acquisition in WA, which we've recently completed rolling out for them. So there is activity on both fronts. So yes, those have actually done well.
Thank you. Returning to our phone questioners, and our next question comes from Peter Michaelboyk from Select Equity.
Hey, you're back on.
Please go ahead.
He's waiting for you. Just called you. Quick. No, still can't hear you.
Pardon me, Peter, your line is live.
Your line is live, Peter. Your line is live. That's fucking radio silence.
We will move on. Your next question is a follow-up question from Gary Sheriff at Royal Bank of Canada. Please go ahead.
Yeah, final two questions. Just on pricing for Visage, can you guys give us a rough like-for-like comparison of price growth per study? So if I were to go back a couple of years, and let's say you allocated a contract to Hospital A, what has been the price growth to something of a similar size that you've let, say, of late? I'm just trying to get a sense on a rough, high level, Visage-only price growth over the past couple of years.
Yeah, the last 2 or 3 years, we have had pricing increase per exam. It'd be roughly 30% increase per exam. So we have seen some pricing tension there and been able to move up our pricing once we've been able to establish some referenceability.
I think the important thing, Gary, is it depends on when they buy it from us. So the ones that bought most recently pay the latest price. So we don't have, favoured pricing. So people often ask us to get partners on Mayo. Did you, change your pricing model? The answer is no.
Yeah, and finally, just in relation to acquisitions, I've been covering you guys since 2015, and you've talked about it, but nothing executed yet. And I'm just trying to get a sense, is it due to not many opportunities are at a good fit? Is it price? Or is it simply that, I guess, the organic growth has been so strong it's been put on the back burner?
Well, I think organic growth has been strong. So the first thing is it's not on the back burner, but we don't need acquisition to meet our growth targets. The second thing is we haven't found, clearly an opportunity. There hasn't been anything where we've looked at it and said, gee, we really want that and price has been an issue. Not at this point. Now, our preference has not been to buy market share, and I think we've always said that we find that it's difficult to amalgamate technology platforms and, do what Philips did with Carestream. Now, theirs may be for different reasons, but that's not our preference. Our preference would be to find something that is adjacent to what we're doing, where we can add value through the platform and through the client base. And at this point, yes, we've looked at some things, and as you can imagine, there are a number of, investment houses that are bringing forward things, but none that have actually, we find that we think we can add significant value to. So, but we're still looking.
Very clear. Thank you.
Thank you. We will try again to take a question from Peter at Select Equity.
You go, Pete. Again.
Peter, your line is live.
They're trying again, Pete.
Thank you, Mark.
He said, is that you, Mark?
If you just move closer to the microphone or the handset, please, Peter, we might be able to hear you.
Comedy of errors. They've called you 3 times, Pete. Called you 3 times.
Yeah, your line is live, sir.
4th time.
We will move on. We do have another question. This is a follow-up from Chris Cooper at Goldman Sachs. Please go ahead.
Yeah, thanks for taking the follow-up. So just on receivables, I mean, it's up sharply in the year. I mean, I read your comment saying there's a lot of invoicing late in the year. Can you just comment about what was different on this occasion that necessitated that change?
Oh, there was nothing different. It was just, on this occasion, the main thing was the implementation of Partners Healthcare. So it does, the timing of our implementations being the last week of June when we first raised it, it does obviously increase the receivables this time, but timing from previous years may not be that we have an implementation in the last week of June. Could be in March, and we would have received the money before year end. So I think it was unusual this year because of, one, we do a lot of our quarterly invoicing at the end of June, and that increases because we are increasing the volumes. But also in the last week we had quite a large amount for Partners Healthcare.
Okay, so if we were to adjust for partners and obviously the higher sort of run rate of the business this year, that sort of ratio would look in line with historical years?
Yeah, I think so. I believe it'll increase as we increase our revenue, but yes.
Got it. Okay, and just lastly on margins, you've been commenting for a while that the rate of expansion is going to slow. You've had a concerted year of higher OPEX investment, I think it's fair to say. Are you now in a position to perhaps comment on what your sort of near-term and mid-term aspirations might be on the margin side?
Well, for me, as high as possible, but there is a limit. It's not so much that it's slowing, but we are, once you get sort of close to and above 50%, clearly, the room for growth, the headroom is not as great. But that's not to be interpreted like we think we're maxed out. We have some new things that may help us, and one of the questions before was around cloud. May help with margins, particularly in getting smaller players on with less effort. So there are a number of things that we're looking at from both an operational and implementation point of view that may help tweak it. But as I said, once you get past 50%, and that's on an EBIT line, I think the headroom is getting less and less.
Got it. Thanks.
Thank you. Next, we have a follow-up question from Josh Kannourakis at UBS. Please go ahead.
Hi, Sam. You actually just mentioned something that I was going to ask a question about, and that was talking about some markets outside of the top tier of US hospitals, so looking at some of the midder and maybe potentially smaller players and your capability to do that, and obviously your architecture suits the cloud. So can you maybe just elaborate a little bit on your strategy for some of the markets outside of the top tier of US hospitals and how you're attacking that at the moment?
Yeah. Look, what's happened is the market's not in well-defined tiers. The most active and the biggest dollars are in the top tier, and thankfully we're winning most of those. Then when you look at things like the private market, that's currently in deep freeze, simply because corporates are all trying to buy out every single practice, and there's been a lot of press about it lately in the US because some of the corporates are pulling back, saying that they can't make the multiples work. So radiologists, particularly private practices that are looking to either sell or buy, don't buy, sell or buy themselves, don't buy technology. So, but we are seeing more in the sort of mid-sized, smaller-sized regional hospitals. We did announce Carl in the half year. We didn't announce it when we got it, but to say, look, we are doing, and they're a great client. They're expanding. They love the product. They're just not going to ever be as big as a Mayo, but there are a number of those. But having said that, one of the other things is, even though we think our systems are far the easiest from a technology point of view to implement, and I think up to 10 times easier, maybe more than anyone else's, you still need some IT infrastructure and people. And for those groups, I think cloud could be a good option. And we're also seeing just on cloud, some of the bigger groups now talking about cloud because newer CIOs coming in, maybe more cloud aware, if I could call it that way. And you've got companies like Google and Microsoft and Amazon to some degree getting their own health domain expertise and basically saying, look, we're more secure. You're more secure in our cloud than you are, in your own data center. So I think one of the key strategies will be making a cloud offering that, you could basically say, here's the blue cable. And the other strategy outside these tier ones is clearly other geographies. And again, that's a whole other discussion, but whilst America's our main market and that's where most of the activity is, we're starting to see rumblings coming out of Europe and other places where people are looking at the US and saying, okay, we want to move in years ahead towards that model. So cloud-based will be one for the mid-tier, and open other markets, we hope will occur, slowly but surely over the next, 12 to 18 months.
Okay, great. Thank you.
Thank you. Excuse me. Returning to our webcast questions for a moment, we have a follow-up from Nick Robertson from Yarden, who asks, can you outline your specific R&D spend? Many of your competitors look to have larger R&D budgets. Does this mean they will eat into your 18-month lead? Yeah,
our R&D spend has remained relatively fixed over the period. The only difference in reporting is generally in AU dollars. So, if the Australian dollar weakens, clearly what we report is a higher number. It's roughly between $6.5–7 million. We think that at this stage we're clearly not losing out on opportunities because of the percentage of R&D that we spend. We do have retained earnings, so if we do feel we're missing out on opportunities, that could be one area where we could certainly increase the amount of spend we have in that areas. But at this stage, we don't feel like we're missing out. In terms of our market lead, again, if that starts to get eroded, we think that we could put our foot down on our development spend. We haven't seen that in the past, but we're always, looking at it to make sure we stay ahead.
Yeah, and just on that, on the lead, again, I made some commentary. There has been one or two competitors in the market over the last few years that have redeveloped and come out with, quote, a streaming platform. Now, the server-side streaming is just one of a number of technologies that are proprietary to us. And we now know that some of these competitors are having difficulty. It's proved to be much harder than they thought. And then again, as Clayton said, we're not moving still either. We're always developing, always bringing out new product. And as we've said, R&D is relatively fixed, but we think, there will be incremental new hires, which you would expect. But we don't need some huge capex step up to stay ahead. If anything, we think the 18 to 24 months could be conservative. But look, in technology, things change quickly, and you don't want to be caught asleep. So, we're comfortable where we are, and we know that, yes, we will have some incremental expenditure and extra heads back in Berlin, but as a percentage of revenue, it keeps going down every year.
Thank you. Returning to the phone questions again, we have a follow-up from Claude Walker at Ethical Equities. Please go ahead.
Hey guys, just on that point about the R&D, as I understand it, with the development of the AI capabilities and I think possibly with the application to new ologies, is that just something that you will sort of then automatically roll out in a Visage update and all existing customers will get, sort of increasing the value of the product they currently have, or is it something you sort of try to sell extra?
Okay. Good question. The AI under the bonnet, everybody gets. So we are the most, if you want to think of it, automatic of products. So we can open up, two PET scans and compare lesions between the two, but you need to click on one lesion and then compares it to the previous one and does a whole analysis for you. With AI, it would be possible in the future that you don't need any clicks, that when you open up the case, the whole thing is fully automatic. So clearly radiologist productivity, clearly accuracy, doing away with more mundane routine, routine measurements, we think will take us to the next level in terms of feature function, over and above, new forms of breast imaging that we cater for and other things like that as new technologies come about. But then on the AI side, if we are looking to open our platform to third parties where radiologists can decide which applications they want to use. And that would be more like a, for want of a better description, an app store approach where we get a pass-through for validating it and integrating it onto the platform. So that would be separate, and we would charge separately for that. And if organisations use us as a key research platform, that's a different commercial arrangement to, using it as the viewer.
Thanks. That's a great answer.